The current live stock price for Rezolve AI, RZLV, is $2.64, showing a steady intraday climb of roughly 1.93% as the market processes the implications of its latest fiscal adjustments. While most retail investors are busy tracking the massive volatility in Nvidia stock or waiting for the next move in Apple stock, Rezolve AI has been quietly building a foundation that looks nothing like the speculative tech bubbles of the past. If you look at the immediate data, you'd see a company that just a few months ago was fighting for oxygen, but the reality beneath the surface is that they've effectively secured over $232 million in contracted revenue heading into this year. That is a massive disconnect between the current price and the secured backlog. Most people see a small-cap AI play and assume it's all hype and no substance, but when you look at the $360 million revenue guidance they just put out for 2026, you realize we aren't talking about a maybe anymore. We are talking about a company that has already hit structural profitability on a monthly basis as of late 2025. The market expectation for RZLV was originally pegged at much lower revenue targets, but they didn't just meet those expectations, they shattered them with a 543% growth rate in the second half of last year. This creates a curiosity loop for any serious person involved in online investing. Why is the stock still trading in the mid-$2 range? The tension here lies in the institutional lag. While platforms like Interactive Brokers and Fidelity see significant volume from sophisticated traders, the broader retail audience on the Robinhood app hasn't fully caught on to the fact that Rezolve is now moving nearly 113 billion API calls across their infrastructure. We are seeing a shift where AI is moving from a chatbot novelty into the actual plumbing of global commerce, and that is exactly where Rezolve sits. When you use your SoFi Invest account to look for high-growth tech, you usually find companies burning cash to find a use case. Rezolve did the opposite. They built the use case first, integrated it with global payments, and then scaled. If you're using online investment tools or seeking investment help, you've likely noticed that the narrative around AI is changing from who can build the biggest model to who can make the most from it. Rezolve is proving to be the latter. Their brain power retail LLM is specifically designed for zero hallucination, which is the single biggest barrier to entry for enterprise AI in commerce. If a retail giant uses a standard AI and it gives a wrong price or a fake discount, that's a legal and financial nightmare. Rezolve's reality is that they have solved this deterministic output problem, allowing them to scale to over 950 enterprise customers. This isn't just a speculative bet you'd find on some random investing sites. It's a structural play on the future of how we buy things. Let's get into the nitty-gritty of the recent movement. We've seen a lot of activity in individual brokerage accounts lately, with a noticeable uptick in institutional accumulation. The volume hasn't been explosive yet, which is actually a good sign for those looking for a calculated entry. It suggests that the big players are quietly building positions without spiking the price too early. If you look at the trading data on the Fidelity mobile app or the Robinhood trading platform, you'll see that the 52-week range has been as high as $8.45 and as low as $1.20. We are currently sitting much closer to the floor than the ceiling, despite the company being in its strongest financial position ever. They recently secured an oversubscribed $250 million raise, which means they have zero requirement for additional operational equity. For a small-cap tech company, being fully funded is a rare and powerful state to be in. It removes the threat of dilution that often plagues users of Robinhood fractional shares or those just starting with self-investing. Comment below how many shares of Rezolve AI you currently hold, or if you're looking at other AI plays like Tesla stock instead. I want to see how many of you are actually tracking these enterprise-level infrastructure moves versus just following the big tech headlines. Now, to understand why this matters, we have to look at the business model. Rezolve isn't just selling software, they are building the control layer for what they call Agentic Commerce. Think about how you currently shop online. You search, you click, you filter, you check out. It's a manual process. Rezolve's platform allows for a natural language interface where the AI understands intent, finds the exact SKU, and handles the transaction within a secure environment. This is why their gross margins are hitting 66%, with core software margins exceeding 90%. As they integrate further into payments and loyalty programs through their partnerships with Microsoft and Google, the stickiness of their product becomes incredible. This isn't a nice-to-have tool, it's becoming the essential engine for digital transactions. Looking at the broader macroeconomic pressures, we see a world where companies are desperate to cut costs and increase efficiency. Inflation and labor costs are squeezing margins for retailers everywhere. This is the reality that is driving Rezolve's growth. When a company can automate 112 billion API calls and reach 60 million consumer devices through an SDK, the ROI for the enterprise client is undeniable. While the market might be distracted by the latest geopolitical swings affecting NVIDIA stock, the fundamental shift towards AI-driven commerce continues unabated. For those using Schwab Intelligent portfolios or other robo-advisors, these types of high-growth individual stocks often get overlooked in favor of broader ETFs, but the alpha is found in identifying these infrastructure plays before they become household names. The future outlook for Rezolve is anchored by that $500 million ARR exit run rate target for the end of 2026. If they hit that, the current market cap of around $1 billion starts to look incredibly undervalued. Usually, software companies with 90% margins and 500% growth trade at much higher multiples of their recurring revenue. The risk, of course, is execution. Can they continue to onboard enterprise clients at this pace without hitches? Can they maintain their lead in near-zero hallucination tech as bigger players try to pivot? So far, the data suggests they are widening the gap rather than closing it. Their move into the Microsoft Foundry and the availability of their suite on Azure is a massive catalyst that lowers the friction for new enterprise adoptions. If you're managing your own Fidelity IRAs or using a Fidelity brokerage account, you know that the key to long-term success is balancing the high-stability names with these high-growth potential disruptors. Rezolve fits the profile of a company that is being mispriced because it went public via a path that the market is currently skeptical of, yet its operational performance is outclassing almost everyone in its weight class. We aren't looking at a company that is hoping for a product market fit. We are looking at a company that is struggling to keep up with the demand of its own success. As we wrap this up, remember the contrast between expectation and reality. The expectation was that Rezolve was just another AI startup with a catchy name. The reality is a company with $232 million in contracted revenue, 90% software margins, and a fully funded balance sheet that requires no more cash to reach its 2026 goals. Whether you're trading through interactive brokers, fees-conscious platforms, or keeping it simple with the Robinhood Investments interface, the numbers here demand attention. The market often takes time to realize when a company has fundamentally changed its DNA, but for the observant investor, that delay is where the opportunity lives. Keep an eye on the volume and the upcoming quarterly reports, as any confirmation of that $360 million revenue guidance will likely be the trigger for a significant re-rating of the stock price. Stay grounded, keep looking at the data, and don't let the noise of the bigger tickers drown out the signals coming from the infrastructure layer of the AI economy.